Hello and welcome to another episode of Smart. Till now, we have learned a lot about stocks, starting from the basics to working and then the analysis. Now it's time for some practical knowledge and explore what you should not be doing as a stock investor. Learning from the mistakes of others is important in your life. When it comes to money, it is even more important because you don't want to lose your hard-earned money in the stock market. So let's understand the common mistakes that the investors make. The first and the most common one is lack of research and blindly following trends. Imagine you're at a party and everyone's gathered around one guy who's confidently explaining how eating a toothpaste is the next big health trend. Without thinking twice, you grab a tube and start squeezing. Halfway through your minty meal, you realize it's just a toothpaste and you've been fooled. Similarly, in stock investments, you never know which stock is cool and which one is making you a fool. Hence, you should always do your own research before investing or take help from a trusted source like a licensed financial advisor. Unsolicited advisory from friends, family, social media, etc. should be avoided. Look out for the company's fundamentals, growth prospects, and market condition. If it's a long-term play, focus on the financial health and competitive edge of the company over its peers. The next common mistake is timing the market or attempting to predict the market. Now, I can't say that everyone who is trying to predict the market is making a mistake because some people actually do, but they are professionals with years of experience and qualifications to do that. Not everyone can predict the market accurately. Most people try to sell when the indices and stock prices are high and buy when the prices are low. Theoretically, there is nothing wrong with that, but practically, this cannot be done by 98% of stock investors. The reason is that you never know whether the price that you think is high is actually high or the price that you think is low is actually low. Suppose you sold your shares when you thought that the prices are high in an uptrend. Now, according to your predictions, the prices should fall from here. But it can also shoot up from this point and you will end up losing the opportunity to gain. Similarly, when a stock is falling and you decided that this is the right time to buy the stock, because the stock is available at cheap. But what happens? It falls further down, leading you to losses. Hence, timing the market can be a huge mistake in stock investments. Instead of timing the market, focus on time in the market. Long-term investors typically benefit from the overall upward trend of the market. Consider rupee cost averaging to reduce the impact of volatility. The third common mistake is lack of diversification. If you do not diversify your portfolio, you are taking very high risk by keeping your eggs in one basket. Let's say you are bullish on a particular stock or sector and invest heavily in it. If that stock or sector underperforms, your portfolio suffers dramatically. Diversify across different industries, sectors, or even geographies to spread risk. Consider mutual funds or ETFs if individual stock picking seems too complex for you. The fourth common mistake that investors do is they target the short-term gains. Many new investors in the stock market tend to search for the stocks that can make them rich quickly. For this, they expect the stock to provide unrealistic returns in short period. And if they don't get it and see some other stock providing it, they will withdraw and invest in the other one. Hopping from one stock to another for quick gains can be a big mistake, as you will not only be paying more in transaction charges, but will also miss on the long-term growth of that stock. Investment should be done for long-term growth based on the potential of the company. Stock investment is not a get-rich-quick scheme. Another common mistake that stock investors make is that they chase past performance. They make their investment decisions solely based on the return that the stock has delivered in the past. You must understand the fact that in stocks, past performance is not the guarantee for future returns. There are several other mistakes that investors do in the market, like making the investments without research, making investment decisions based on emotions, ignoring the fees and costs. You should always check the fees and charges that you are paying for the transaction in your Demat account. As you navigate the stock market, it's important to recognize and learn from common mistakes. By staying informed, avoiding emotional decisions, and sticking to your long-term strategy, you can build a stronger foundation for your investments. Remember, every investor makes mistakes, but what sets successful investors apart is their ability to learn from them and continuously improve. Stay focused, stay disciplined, and most importantly, invest with confidence. Thanks for watching. If you know about any other mistakes that you have made apart from the ones that I have mentioned, let me know in the comments below.
Investments in securities market are subject to market risk. Read all the related documents carefully before investing.